You know, when you think about what makes a company strong, you might think of its products or maybe its famous CEO, but what really holds it all together? Well, today we're going to pull back the curtain and look at the real foundations of a business, its non-current assets. Let's dive right in.
So if you're ever thinking about putting your money into a company, this is the question you have to ask. And the answer? You're not going to find it in some glossy ad or a Super Bowl commercial. Nope, it's hidden in plain sight, right here in the company's balance sheet. This thing is like an X-ray, showing you the company's real, unfiltered financial health, the good, the bad, and everything in between.
Okay, so just think of a balance sheet as a simple snapshot. That's all it is. On one side of the picture, you've got what a company owns, its assets. This is all the stuff that's supposed to make money down the road. And on the other side, you've got what it owes, its liabilities, its debts. It's pretty straightforward. You want to see that scale tipped heavily towards the owns side. That's a good sign.
All right, let's dig a little deeper into that owns side of things, because, not all assets are created equal. They're actually split into two really interesting categories, and each one tells a totally different story about the company.
First up, we've got tangible assets. And yeah, it's exactly what it sounds like. Tangible. It's the stuff you can literally walk up to and touch. The real physical things that make a business, well, a business.
Yeah. Think of these as the bones and the muscles of the company. We're talking about the actual buildings, the giant machines on the factory floor, the fleet of delivery trucks, even the chairs and desks in the office. The rule of thumb is pretty simple. If you can kick it, it's probably a tangible asset. Okay, but now, this is where it gets really cool. Some of a company's most valuable assets are things you can't see at all. They're completely invisible. You can't touch them, you can't feel them, but they can be worth an absolute fortune. Billions.
These are kind of like the company's brains and its street cred. I mean, think about Microsoft Windows. It's just code, right? But it's an incredibly valuable asset. Or think about a patent for a life-saving drug, or that iconic Coca-Cola logo. You can't put those in a warehouse, but they're priceless. And get this, for a lot of big companies today, these invisible, intangible assets are worth way, way more than all their buildings and machines combined.
Okay, enough with the theory. Let's see what this looks like in the real world. We're going to take a peek at the balance sheet for Toyota Pakistan.
So one of the first big things you'll see listed is something called property, plant, and equipment. Everyone in finance just calls it PP&E. It's basically just a fancy way of saying all the big physical stuff. It's the category where they lump together all those tangible assets we were just talking about.
So you're looking at Toyota's balance sheet, and you see this number next to PP&E. At first glance, you're thinking, okay, $16.5 million. But then you stop. Wait a second, for a giant car company like Toyota, that sounds kind of small, doesn't it?
And you'd be right to be suspicious. Here's a little pro tip for reading any financial report. Always, always look for the fine print. See that little note there? It says rupees in thousands. That one little detail changes everything. It means you have to add 3 zeros to the end of that number to get the real value.
And once you do that, boom, the whole picture just explodes. That 16.5 million isn't 16.5 million at all. It's over 16.5 billion rupees. Now that makes more sense. That's the real scale of Toyota Pakistan's physical backbone. All their factories, their equipment, the whole shebang.
But a company is more than just its buildings and machines, right? So let's keep going down the list and see where the story gets even more interesting. Okay, the next thing you might see is long-term loans. And I know what you're thinking. Wait a minute, a loan. Isn't that a debt? Something you owe? That's a liability, right? So what in the world is it doing over here in the assets column?
It's a great question, and the answer is all about which side of the deal you're on. See, if you take a loan from a bank, that's your liability. You owe them. But if you give a loan to somebody else, well, now they owe you, and money that's owed to you is an asset.
So why would a company be giving out loans? Well, a lot of big companies offer loans to their employees, maybe to help them buy a car or a house. For the employee, it's a great perk. But for the company, that loan is now a chunk of money that's legally owed back to them, usually with interest. So it goes on the books as an asset, a future source of cash.
All right, next up, you'll often see long-term deposits. This one's way easier to understand. It's basically just cash the company has parked somewhere for more than a year to earn some interest. Think of it like a corporate savings account. It shows you the company is being smart with its extra cash and planning for the long haul.
Okay, now for the last one. And this one is a bit of a mind bender. We're going to talk about taxes, and specifically how paying your taxes can, weirdly enough, create an asset for your company.
Yeah, it sounds strange, I know. It's called a deferred tax asset. Now, that sounds super technical and boring, but the idea behind it is actually pretty simple. It happens when a company ends up overpaying its taxes for a certain period. And this isn't usually a mistake, it's just a weird quirk of how accounting rules and tax rules don't always line up perfectly.
Here's an easy way to think about it. Let's say your company's tax bill's $100, but for whatever reason, you end up paying $150. Well, that extra $50 doesn't just disappear into a black hole. It becomes a credit. It's like you have store credit with the government. You can use that $50 to pay less tax next year. And because that credit has future value, guess what? It's an asset.
So let's just step back for a second. When you add all this up, this one little section of the balance sheet tells you a whole story. The PP&E shows you the company's physical muscle. The intangible assets show you its brainpower and ideas. And things like loans and deposits, they show you it's making smart, strategic moves with its money.
So, the next time you look at a balance sheet, don't just see a bunch of numbers. Try to see the story they're telling, because you now know how to read the blueprint of a company's long-term plan. You're not just a passive observer anymore. So what story are you going to find in your next investment?